Hi, it's about that time to give you an update on the market. And for today, we're going to talk about interest rates. Mortgage rates, of course, are the heartbeat of our business, offering the greatest insight into whether home ownership is affordable. So it's no surprise that when the headlines scream that rates are on the rise, while others declare that rates are historically low, borrowers have questions and concerns. Historic context is key to understanding how rates behave. The downward trend of rates the last 20 years proves that buying a home truly is a better option than renting. So just what are mortgage rates? Just like any loan or line of credit, mortgages come with interest, which of course is the cost of borrowing money. A host of market factors beyond the lender's control determine what those rates are, including activity on the bond market and how apt investors are to buy mortgages bundled as securities. Rates have actually been falling for years. We'll use the 30-year fixed rate mortgage as a benchmark since they're the most popular home loan option in the U.S. and often used as a basis for news and research findings. Rates on 30-year mortgages peaked at just over 8% in the year 2000. They were as high as 18% in the early 1980s. Rates have been on a steady decline over the last 20 years. Sure, there have been ups and downs, the most dramatic of which was the credit crisis that drove rates to historical lows. But rates overall are influenced by economic activity, inflation, and monetary policy. Now, the fact remains that buying a home was a bargain back then and still is today. Let's take an example using the national median price home. This is not California's median price. In June 2000, the median price of a home was $140,000, and the rate on a 30-year mortgage was 8%. If a borrower financed this at a 90%, the principal and interest payment was approximately $925 a month. Compare that to 2017, when the median price of a home is $245,000 and the 30-year mortgage rate is 3.8%. If a borrower finances this at a 90% loan to value, the principal and interest payment would be approximately $1,025 a month. Hard to believe, but this shows that in the span of 17 years, the average mortgage payment has increased by just $100 on principal and interest only. This does not take into consideration property taxes and insurance, which vary across different states. And rents. Rental rates, meanwhile, continue to rise with no sign of slowing down. Last year, the Wall Street Journal reported that rent in 2015 increased 4.6% to approximately $1,180, up from $1,125 a year earlier. Put that in perspective. Rent went up about $60 in the span of a year, exceeding the average cost of a mortgage, while the cost of owning a home went up $100 in a 17-year time frame. The obvious bottom line is home ownership over time is a better investment and more affordable than renting. Rates will rise again. It's inevitable. As the economy strengthens, as it has been, mortgage rates are going to rise, potentially reaching 5% by 2019, according to the Mortgage Bankers Association. We are currently looking at a rise in interest rates in December and again in February 2018. Well, I guess the number one question I'm always asked when people know that I'm a realtor is, how's the market doing? Well, that actually depends on whether you're a buyer or a seller. It is a seller's market right now. But in the case of interest rates, sellers, if you're thinking about selling your home, there are buyers and buyers and buyers out there that are really wanting to take advantage of these interest rates. Buyers, I really encourage you, if you're serious about buying, lock in a rate, get out there and look at these homes. They are out there. And please call me. Let me know what I can do to help. Any questions, anything. Get a hold of me, okay? Let me also take this opportunity to thank you so very, very much for the great year that you have given me. And from my family and my home to yours, a very, very happy Thanksgiving. Safe day, beautiful day. Enjoy. Bye.